No one becomes financially literate overnight. Since most people don't learn how to adjust their finances, for better or for worse, until well into their 20s, 30s, or even later, they realize that there's a lot of catching up they need to do. However, this is no reason to feel discouraged. Luckily, plenty of resources and apps can help you get your ducks in a row a lot faster than you think. The intersection between personal finances and technology has often been a cause of concern for many, and sometimes with good reason. With so much of our information online these days, it can be easy to fall prey to identity theft or scams. Yes, it can be scary, but you should be fine if you follow some basic protocols and are careful about the sites you trust. Now more than ever, technology isn't the enemy. In fact, when it comes to your finances, you should let technology help and do some of the work for you. This chapter will cover a few crucial techniques to help you make the most of the resources available to you to get closer to meeting your financial goals. Tracking expenses. There are a few key ways in which some technological tools can be used to help you track your expenses. Before you start, the first thing you need to do is figure out your spending habits by taking stock of all your accounts. Credit card companies and the vast majority of banks, maybe all of them, including smaller operations, will have an online portal that makes it easier to check your accounts. If you haven't signed up for the online portal, you should take the time to do so. It should only take a few minutes anyway. Then, you should have all your accounts, including consumer debts and your mortgage, right at your fingertips. Looking at these accounts will help you precisely determine what you're spending and what. It will also spell out your cash flow situation, which is important. So now you have an easy-to-access snapshot of your financial reality. But you can't keep logging on from your desktop computer or laptop every day to continue keeping track. So you'll need an easy way to keep up with your spending habits. Enter one of the first powerful tools available to you: online apps. You can look into different kinds depending on your own unique needs. So let's pause for a minute and figure out the kinds that may be most useful to you. Online banking. There are tools available in the online portals for your bank and credit cards that you should look into. The way to get the best out of these features is to get used to automating everything. For example, set up regular credit card payments to automatically deduct the money as soon as you get your check deposited. Also, set up automatic payments to a rainy day fund, your 401k, and the account you've set up for other things, like putting a down payment on a house. Even modest contributions will help. Just make sure to get everything done automatically so that you don't overthink it. As they say, out of sight, out of mind. Apps that can help. In terms of apps, you should look at the ones specially designed to help you build a budget, which then help transform your financial decisions. Sometimes, putting pen to paper to have a set budget in mind can be overwhelming. But apps can help take the guesswork out and will make it easier to manage your finances on the go. All you need to do is to input your information into an app. Mint, or the aptly named You Need a Budget, are good places to start. And you will get an idea of what and how much to set aside every week or month. The old 30-20-10 rule, 30% living expenses, 20% fun, and 10% savings, does not apply to every person. In fact, you may be able to set aside far more than 10% in savings, which is preferable. Apps will help you do just that by letting you allocate a certain part of your income, depending on what you need and what your debts look like. Furthermore, the apps can be synced to your bank accounts, so you will be able to know exactly what you're spending at all times, and you will be alerted right away if you fall into the trap of taking your account into overdraft. Wondrous Excel. Okay. So, most of us may hate spreadsheets or keeping track of our expenses in a Google Sheet. However, if you can't have apps work for you, you may need to reroute your efforts more effectively. Online spreadsheets are an excellent way of keeping track of your money, and there are plenty of free budget templates you can find online to help motivate you. They will make entering your expenses a lot clearer, and you can use the formulas in template sheets to determine the elements of your income you want to automatically set aside for other endeavors. Alternatively, If you have a lot of complex finances to keep track of, you may purchase online software to help you. Quicken is a classic, and it lets you import all of your bank transactions in a second while also helping you to monitor investments and other lines of debt you need to keep an eye on. Apps are excellent for some people, but others may benefit from the detail-oriented approach afforded by online sheets or software since it forces you to be more mindful while impressing upon you the importance of paying off debt sooner rather than later. Even better, both software or any form of the sheet you use can be easily accessed on your phone or any portable device you carry, so financial investing is a breeze. Benefits of online tracking. Online tracking has many clear benefits. While you can also keep a physical financial planner at the ready, that tactic doesn't work for everyone. A definite plus on the side of online tracking is that it makes it easy for you to check in on your accounts and spending immediately. Apps or software are always easy to access on any portable device you carry, not just your desktop, so you can cull the required information in a second. This helps to keep you far more accountable, which is necessary if you're still learning the basics of financial literacy, or trying to undo the damage incurred by overzealous use of a credit card when you were a college student. You can set up warning messages on your phone to let you know straight away if you've overspent, if you are using money meant for a different savings account, and so on. Possessing that familiarity with your finances is necessary to help you exercise good habits and dispel any anxiety that comes with keeping on top of your money. Lots of people avoid looking at their online accounts for fear that they may see how far behind they are on meeting their goal. This, of course, is a self-defeating impulse since you can't meet your financial goals without knowing your budgeting system is effective. Online tracking is one vital piece of the puzzle. Best budgeting apps and software. So now we know the different ways in which technology can help you if you are amenable. Now you're probably wondering, which apps and software do I look into? The following is a quick list and review of the best tools available online and will provide the benefits and drawbacks of each one. You can decide which is best for you. You need a budget. This was mentioned above, and it's a really excellent tool for newbies who need some guidance creating a feasible budget. If you have no idea where to start, then this is the tool for you. Pros: easy to import data, allows you to be flexible with shifting financial goals, and shows you how each dollar in your account will work to your benefit. Syncs with tens of thousands of banks, so you should be able to get things set up in just a few minutes. Not sure if it's the tool for you? There's a free 1-month trial, which gives you a chance to assess the app. Cons: the cost may be steep, nearly $12 a month, which can be tough for people trying to climb out of debt to pay. Also, you can keep track of potential investments, and the app doesn't provide a general overview of your financial health. It really focuses on your need to create a budget and little else. Mint. Another popular app that has already been mentioned here, Mint, has been increasing in popularity. It's one of the oldest budgeting apps on the market, and it has a loyal customer base. It's excellent for providing a general overview of your financial health and can help you assess where you need to go. Pros: easy and free to use, thus accounting for its popularity. You can also set it up to receive financial summaries and alerts via email or text, whichever works best for you. Also, you can easily obtain a copy of your credit score, which is essential in figuring out if you're doing okay financially or need to implement better spending habits. Cons: you can't really use this app to invest. Furthermore, it doesn't always synchronize with the more niche bank accounts, so you may find yourself stranded in the cold. Users have also experienced trouble assigning more than one savings goal to one bank account, which isn't the best way to organize your finances. And free doesn't always mean convenient, since you may receive more intrusive ads than you would like. Lending Tree. You can access Lending Tree's services via any web browser, but they also have a great app you could download. They're best known for being a viable referrer to loans while also helping you keep track of your credit score. It also tracks your spending and monitoring your net worth, which is extremely helpful. Pros: provides a complete overview of your financial outlook. It is also excellent in terms of functionality, and it allows you to monitor different areas of your financial realities, which other apps may not be able to do. Cons. Some people in vulnerable financial situations may be pulled into the personal loan offers, which is not sound financial planning. While the loans tend to boast affordable interest rates, it's usually best to avoid these things since they may lure you into spending more than you can afford in the long run. Also, customers have reported receiving annoying telemarketing phone calls once they've shared their phone number with the app. QuickBooks. This is the gold standard accounting software that has been readily available for individuals and businesses for decades. The software also comes with apps that you can easily download onto your phone or tablet to make the information easy to access. Pros: easy import of all invoices and banking details. Also, it allows you to keep track of investments, so it's a great motivator for people who are ready to move on to achieving more complex financial goals. Tracking of spending is straightforward to automate. Cons: it is a bit more complex to use, so it may be better for people ready to move on to other financial goals. The subscription costs can be costly, and some individuals may feel that the process is too involved for personal financing. Relying on technology to help make the process of becoming more confident with your financial literacy is a good move, especially for people new to the game. Apps and software can help you create an airtight budget with few vagaries that may be hard to miss when you use traditional pen and paper. Also, never underestimate the power of having so much of this work automated. It will take a huge load off of your shoulders and help with any feelings of anxiety you may have when it comes to your finances. Debts and loans. At some point in life, we all face financial challenges that can prevent us from getting the things we want. Fortunately, if you need money to cover something that requires immediate attention, you can consider a loan or debt. You can use a loan within the agreed terms and conditions. When you decide to get credit, there are different things you should know. This chapter explains what debt is and outlines the techniques to consider paying off your loans quickly. We also cover facts that potential borrowers should know about student loans. This chapter also covers pertinent things like helping the reader know how credit works and when and how to start paying off loans. Finally, we explain what bankruptcy is and when to consider it. What is debt? Debt refers to money borrowed by one party from the other with a promise of repaying it, usually with interest at a later date. Many people and corporations use debt to make big purchases that are not easy to afford using savings. A borrower approaches the lender, who in most cases is a registered financial institution like a bank, credit union, or any recognized entity. Understanding debt. Debt loan is mainly classified into 4 categories: secured, unsecured, mortgaged, and revolving. The most common types of debt include personal loans, payday loans, mortgages, credit card debt, student loans, auto loans, business loans, and others. Secured debt. Secured debt requires collateral that is worth more than the money borrowed. If the borrower defaults on their repayment obligation, the lender can repossess the asset used as collateral. Various assets are used as collateral, including houses, vehicles, boats, and investments. Unsecured. This type of debt is not secured by collateral. The debtor's ability to repay the loan is considered. However, this kind of debt usually comes with high interest, since the debtors are often viewed as high risk. Unsecured debts include student loans and automobile loans. The amount of money you can get if you want this type of debt depends on income and employment status. Revolving debt. This is a line of credit where you can borrow continuously as long as you pay back the funds owed. Credit card debt is a good example where borrowers continue to access debt from their providers. Mortgages. This is a special type of debt meant to purchase real estate like a house. This is a secured debt, since the property purchased is used as collateral. If the borrower fails to repay their debt, they face the risk of foreclosure, where they lose the property and money. Mortgage and student loans are probably the most popular types of loans, since they are repaid over long periods ranging from 10 to 30 years. The terms and conditions of a loan stipulate that the borrower must repay the money owed by a certain date. The borrower should also pay interest as part of the credit terms. Techniques to pay off debt quickly. When you seek a loan and get it, the next thing is to repay the money as agreed. Your lender stipulates the repayment terms and conditions of your loan, and the onus is on you to pay it quickly. Late repayments can lead to high interest and penalties that can seriously impact your financial situation. The following are some of the techniques you can use to pay off your loans. Make extra payments. You can significantly save on interest by paying more than the required minimum payment every month. If you pay the extra money, it reduces the principal balance. However, you need to check if extra payments do not attract additional fees or penalties. Another strategy you can consider is maintaining consistent payments on your credit card every month. Avoid late payments to prevent penalties and high interest. You can also lower your usage ratio by making regular payments. Start with high-interest loan. If you have more debts, you should start your repayments with the most expensive loan with a high interest rate. When you pay this debt first, you decrease your overall debt and reduce interest. This is also known as the avalanche method, and it significantly lowers your overall costs on loan repayment. Alternatively, you can consider the debt snowball method, where you start by paying the smallest and then move to the largest debts. However, you should pay a minimum balance on any other debt you have. This will help you eliminate smaller loans and focus on the big picture. Debt refinancing. You can refinance your debt to a shorter term to pay it faster, and this will save you on the cost of borrowing. You will repay your debt at the same interest rate, but the life of your debt will become shorter. Similarly, loan consolidation is another level that helps you combine different loans with high interest rates into a single loan with a lower interest rate. This method helps you focus on a single debt, which lowers your monthly expenses. You can easily pay off your outstanding loans when you have more cash. Reduce monthly bills. When you reduce your monthly bills, you will have more money, which helps you repay your debts quickly. It is essential to stick to your budget and try to eliminate unnecessary expenses. For example, you can do away with monthly subscriptions that do not add value to your finances. When you lower your monthly costs, you will be able to make high installments on debt repayment. Earn extra cash. Try to look for a side hustle that will give you extra cash to repay your debts quickly. You can use your skills during your free time to generate additional income. You can consider a freelance gig to earn extra money while maintaining your daily schedule. Other activities, like babysitting, dog walking, or online marketing jobs, can give you additional money. Furthermore, you can sell unwanted items in your home, like toys, jewelry, unused clothing, and books. Things to know about student loans. When you enroll in a college or university, you can apply for a student loan, which you will use to cover your educational expenses. However, it is vital to understand the application process and repayment terms associated with this kind of loan to make an informed decision. You can apply for a federal or private loan to fund your education. You need to consider the following factors when applying for a student loan. Type of loan. It is a good idea to choose a federal loan since it does not require credit history, it offers a flexible payment plan, and you can get loan forgiveness. If you get subsidized, it will not attract interest while still in school. However, a private loan does not offer all these benefits. You can only apply for a private loan when you fail to qualify for a federal loan. When you apply for a student loan, make sure you get what you want to use. Applicants for both federal and private loans have a maximum amount they can get per year. This also determines the total amount they will get. You should use a student loan calculator to estimate your repayments. Interest and fees. You should know that you pay fees and interest on your student loans. You must check the fees and interest rates to calculate the total amount you will need to repay. If you apply for a private loan, the lender will consider your credit history or your co-signers to determine the appropriate interest rate. Your school handles the loan. When your loan is approved and you agree to the terms, the money is paid to the school. The students will only get leftover money to use on other expenses when the school has deducted the required funds for their education. You cannot use your student loan for other activities like vacations or anything unrelated to your education. Make sure you use the money for transportation, personal supplies, and other education-related expenses. You may experience problems in paying back your loan if you are tempted to use it for other purposes. You also need to find out when to begin payments and get details about your servicer. When and how to start paying off loans. Different types of loans come. When and how to start paying off loans. Different types of loans come with various terms and conditions that include the repayment period. For instance, federal student loans come with a grace period of 6 months after graduation before the commencement of repayments. The grace period is meant to allow the graduates to look for work and settle first. Once the grace period is over, monthly repayments should begin. If you have a different type of loan, make sure you understand the terms and conditions before signing the agreement. If you are dealing with a private lender, they will require the borrowers to start repaying their loans beginning the following month. Private lenders are a bit strict, so make sure you make consistent and timely repayments to avoid penalties and high interest. As explained in the section above, there are different measures you can take to repay your loan. However, you can consider loan forgiveness if you cannot afford to repay your loan in full. The Public Service Loan Forgiveness Facility is often extended to students working in the public service. After making specific payments working in this sector, the outstanding balance can be forgiven. If you don't qualify for loan forgiveness, try to talk to your employer or approach debt relief companies to see if they can assist you. However, if you are overwhelmed by debt and feel there is no way you can raise the money within a certain period, you can consider the option of bankruptcy. When to consider bankruptcy. When you feel that you cannot pay off your debts, the option of filing for bankruptcy can give you a fresh start while someone handles your debt payment. While there are several myths about declaring bankruptcy, it is a better decision that will give you financial relief in the long run. Remember, bankruptcy does not mean debt cancellation, but it's a way of making your life easier while managing your debts. The following are signs that should tell you when to consider bankruptcy. Filing for bankruptcy can be tricky, so you must consider your goals and make an informed decision. You can consider filing for bankruptcy when you have outstanding bills but have exhausted all the avenues of getting money to pay them back. When you have tried other methods, like loan negotiation or debt consolidation, but failed, bankruptcy might be the only viable option. When you realize that your house is at risk of foreclosure, you can consider filing for Chapter 13 bankruptcy. Instead of losing your house as a result of a mortgage that's past its due payment, Chapter 17 bankruptcy allows you to keep specific assets. You can liaise with your lender and make a repayment plan to pay off the debt while living in your home. Losing a home is not a pleasant prospect, since you may not be able to buy another one. You can file for bankruptcy to protect your retirement savings, since this will give you a fresh start while keeping your investment. Once you dip into your retirement savings to pay off debt, your future might be bleak, since you may never be able to replace the retirement savings. Many people choose to protect their retirement investments and find other means of repaying their debts. Unexpected incidents in life, such as job loss, sudden illness, a worldwide pandemic, or the death of a family member, can severely affect your finances. This will leave you in financial distress, affecting your loan repayment. Filing for bankruptcy can be the most viable option to help you gain your footing while you take a mental step back and reconsider. However, you should consult a bankruptcy attorney or nonprofit credit counselor before making this decision that can impact your life differently. Declaring bankruptcy can be traumatic, so you should handle it with care. Types of bankruptcy. When you are driven to choose the option of bankruptcy, you should make the best choice. There are mainly two types of consumer bankruptcy, Chapter 7 and Chapter 13. The main difference between these two options is that Chapter 7 involves the total liquidation of your assets, while Chapter 13 allows you to keep some or all of your belongings. Chapter 7 Bankruptcy. When you file for Chapter 7 bankruptcy, all your non-exempt assets are liquidated to recover money to pay back your creditors. With this option, you lose everything, including your car, home, household possessions, and bank accounts. It is commonly known as fresh start bankruptcy, since it leaves you with just your clothes and a few ordinary goods. Your creditors will get paid, and all your debts will be cleared. However, Not everyone is eligible for Chapter 7 bankruptcy, since the candidates who qualify should be earning below a specific level of income. It seems Chapter 7 is more common since many people file for bankruptcy under this option. Chapter 13 bankruptcy. Under Chapter 13, the debtor proposes a repayment plan with the lender where they commit to paying everything due under a new agreement. This option is also referred to as repayment bankruptcy. In most cases, a repayment plan can take between 36 to 60 months to clear all of your debts. By the time you complete your payments to the creditor, you will be clear of debt. You can also make a payment plan with debt management companies who take over your debts and pay them over the agreed period. Chapter 13 bankruptcy allows you to keep most of your assets, but you must prove that you can make the payments under the proposed payment plan. If you fail to maintain the terms and conditions set out in Chapter 13, you risk sliding to Chapter 7, where you will lose everything. Therefore, you must weigh the options available to make an informed decision. Whatever form of bankruptcy you choose, your debt remains in place. Filing for bankruptcy is just a way of removing the burden of dealing with debt collectors from you. It also allows you to start fresh when you have learned some important life lessons. Loans are designed to give you financial relief when you hit hard times. You can get a loan when you want to make a big purchase that requires a significant amount of money you cannot raise. Whatever type of loan you get, make sure you should pay it back, and it is a good idea to pay it sooner to avoid penalties and high interests. There are several ways you can consider to manage your debt. However, if you cannot repay your debt over a certain period, you can consider bankruptcy as a last resort. Understanding banks. When saving money, it's essential to understand how banks work. Choosing your bank and bank account type must be based on your financial needs, and after a thorough investigation of the instructions you decide to use. It is to make the most of the benefits these institutions offer you. How to identify the right bank. The first step you'll need to take is identifying the right bank for you. Here's what you need to know while doing so. Understanding the types of banks. There are three main types of banks you'll have to choose from. Traditional banks. This is likely what you think of when you think of a bank. Traditional banks offer brick-and-mortar offices where they provide clients with banking and other financial services and have ATMs that people can use. They may offer online banking services as well. Online banks. The popularity of online-only banks has grown massively over the years, partly due to their lower fees. The lower fees are a result of no overhead costs associated with physical branches, and these savings are passed on to the clients. They are just as safe as other banks, but you will need to ensure that it is insured by the Federal Deposit Insurance Corps or National Credit Union if you choose an online bank. Credit unions. While traditional and online banks make a certain amount of profit off of your clientele, credit unions are not-for-profit financial cooperatives. They are member-owned, and members can avail of lower fees and higher interest rates. However, they usually have stricter rules for accessing services, and many don't offer online services, which can be a challenge if you need to access your bank account frequently. We'll look at the pros and cons of each of these options further down the line. Choose the right account. We'll go more into choosing the right account for your need further on in this chapter, but you need to know what type of account you're looking to open when choosing a bank. Deciding on an institution will do you no good if you visit and realize they do not allow you to open the type of bank account you want. The other areas you need to consider are their options for debit and credit cards, especially if you prefer going cashless when possible. You should also look at what lending products they offer. This includes things like mortgages and personal loans. While you may not need to borrow money at the moment, it's always best to understand your options in case you need to do so in the future. Look at fees. Ideally, the bank you choose should charge little to no fees. After all, you're at a bank to save money, not spend it. Credit unions and online banks are the best options for low fees, as mentioned above. However, some traditional banks are also taking steps to reduce fees, so keep all your options open. Some major fees to keep an eye on include monthly maintenance fees, overdraft fees, and ATM fees. Overdraft fees are the most challenging. These are essentially the fees that your bank charges you every time you use their automatic overdraft service. The overdraft service is when you withdraw more money from your account than what you currently have in it, similar to taking a small loan from the bank. This means an unnecessary expense can have an extremely significant effect on your budget, depending on the bank in question and how much extra money you withdrew. Because of the financial burden that the overdraft fee causes, many banks have taken the step to eliminate it altogether, so make sure to check on this when choosing a bank. You should also look at taking steps to reduce additional fees, including linking your checking account to another account at the bank. This means if you do overdraw from the checking account, the money is covered by your second account, and you don't have to worry about overdraft fees. This is also known as overdraft protection. Sign up for bank alerts that warn you when you're at risk of overdrawing from your account. Ask your bank if there is a way to waive the monthly maintenance fees. Banks generally require you to have a minimum balance or set up your direct deposits if you want this fee to be waived. Keep the pros of a traditional bank branch in mind. As mentioned above, traditional banks generally have the highest fees of your three options. However, there are several benefits that a physical bank branch offers you that you will not be able to find with an online bank. Physical branches are a great option for people who aren't familiar with the ins and outs of banking and may require help getting their feet under them. With the option of a physical location, you can easily walk in and ask someone for help. While online banks generally have a robust customer service team, it often doesn't make up for an in-person interaction, and many people find online or phone-based customer service frustrating. Traditional banks also offer ATM services, which can be essential for many people. However, bank ATMs can also be accessed by customers of other banks, so if you choose an online bank, you may still be able to use the ATM machines operated by your local traditional bank. If you do decide that a traditional bank is right for you, there are a number of convenience factors you should keep in mind when deciding on a specific bank. Some considerations include whether they offer online or mobile banking services, where their physical branch is located and how accessible it is for you, where their ATMs are located and how convenient those locations are for you. Which of these you should value the most depends on your needs. For example, if you prefer doing all your banking in person, you may focus more on the location of their physical branch. However, if you prefer online banking and choose a traditional bank for reasons other than in-person customer service, you may prefer to focus on their online banking services. Consider credit unions. As discussed above, credit unions are a good alternative to banks. They offer the low fees associated with online banks with the in-person convenience of traditional banks. However, keep in mind that you need to be a member of the credit union in question before opening a bank account with them. Joining credit unions is easier than it has ever been. However, there may not be a credit union you qualify for located near your home, so make sure to research your local options. Some credit unions require you to be a part of a certain subsection of people. For example, the Navy Federal Credit Union is limited to military service members and their families. The American Airlines Federal Credit Union is limited to airline industry employees and family members. That said, it should be possible to find at least one credit union you're eligible for near you, especially if you live in a major city. Several are available across the country, and some allow you to qualify for membership by doing something as simple as donating to a related charitable organization. So if you're interested in a credit union, make sure to take a thorough look at your options. Make sure the bank you choose can support your needs. The bank you choose should be able to support you over the years, and not just at present. For example, if you're trying to save money, look for banks that offer high-yield savings accounts and the ability to open and name separate savings accounts. For example, one account for retirement, one for travel, etc. Ideally, you'll be staying with this bank for the long term, so you don't want to be caught by surprise years down the line. Consider their digital offerings. While most banks today have a website and likely a basic app that allows you to transfer funds, pay bills, and complete other essential functions, Not all offer more advanced capabilities. Make sure to consider what digital offerings a bank offers before making a decision and whether you need those offerings. For example, if you don't plan on applying for a debit card, you probably won't worry about whether your bank will let you lock it and prevent strangers from using it. On the other hand, people who prefer online banking will likely prefer a bank that offers a smartphone app instead of only a desktop portal. Read the terms and conditions. We know that the terms and conditions of any contract are the most boring part, and while you may be tempted to overlook them, you must read them all in detail. There's a lot of important information hiding in the account agreement that you may not find elsewhere on the bank's website, and you can also make sure you're not committing to any hidden fees. Additionally, the terms and conditions usually include things like situations in which monthly maintenance fees will be waived, what out-of-network ATM charges you will incur if you use another bank's ATM, whether the bank is federally insured so that you don't lose out if it closes, when promotional deals expire. This information will come in handy in the long term and can even prevent you from choosing the wrong bank. Read reviews. You can do all the research in the world, but that won't make up for hearing the unvarnished truth from other customers. Seek out online reviews and speak to friends and family who may have experience with the bank you're considering. They can often clue you into things you won't realize at first glance, such as how their customer service is and any challenges you may have to overcome in the future. What about online banking? We've discussed keeping the possibility of online banking in your mind when choosing a bank. But what exactly is online banking, and why is it so popular? Online banking is essentially what it sounds like: the ability to make financial transactions via the internet. It can offer nearly every service you'd get from a traditional bank, including online bill payments, deposits, transfers, and more. However, each bank offers different online banking options, so yours may not offer all the options mentioned above. So, why is it so popular? After all, most people have grown up hearing the dangers of sharing your personal information online, and your bank details are some of the most private pieces of information about your life. If they get out, there are significant privacy concerns you'll have to contend with. While this is true, banks offer safe, secure, online bank platforms that will keep your information private. Of course, you'll need to be alert and take common sense measures such as keeping your password secret. However, in general, it's actually a rather safe undertaking. Online banking is popular for multiple reasons, one of the major ones being the convenience it offers. You do not have to make your way to a brick-and-mortar location and can complete transactions from the comfort of your home. This also means you have to earmark less time for banking, allowing you greater time in your day for other pursuits. Additionally, it's fast and efficient, and funds can be transferred between accounts and institutions almost instantly. You can open and close accounts online without interacting with people if you prefer not to. Most institutions allow customers to monitor and access their accounts around the clock, allowing you to ensure your accounts are safe. This also allows you to detect fraudulent activity quickly, reducing the possible harm to your financial health. Finally, you have greater access to your bank records, allowing you to download and print them as needed. You no longer have to make the trip to your branch in person and wait for a staff member to do it for you. You'll have what you need in minutes, allowing you to complete tax filings quicker. The different types of bank accounts. As mentioned above, we'll now take a look at the different types of bank accounts you can choose from. Which one you choose will depend on your unique financial needs. Checking accounts. A checking account is for money that you'll be accessing frequently or on a daily basis. This is the account from which you will draw the money you spend on groceries, rent, or other similar expenses. For this reason, they're also the most accessible type of bank account and generally have few or no limits when it comes to deposits and withdrawals. These accounts generally do not earn interest, but some banks and credit unions may offer interest-bearing checking accounts. They usually come with a debit card. Savings accounts. These are exactly what they sound like: accounts designed to save money that you won't be spending immediately. You earn interest on the money saved in these accounts, and they are the right option for long-term emergency funds and goals like buying a home. Savings accounts often have some restrictions on how frequently you can withdraw or transfer money from them, and generally don't come with a credit or debit card. Money marketing accounts. Money marketing accounts, MMAs, are essentially a combination of savings and checking accounts. They have a higher interest rate than savings accounts, but also often have high minimum balance rules. Additionally, the number of withdrawals is usually limited. However, some MMAs come with credit or debit cards. They're a good option if you have a high balance that you're looking to save and earn interest on. Certificates of deposit. Also known as CDs, these accounts help you invest money at a fixed interest rate for a fixed period of time. There is minimal risk involved with this account versus many other investment products. Terms vary depending on the bank and the account and range from months to years. You must commit to keeping the money in the account for the entire term, and in return, you're promised a higher interest rate than other accounts offer. You can incur a high withdrawal penalty if you need to withdraw money early, though some banks offer CDs with lower interest rates and no penalty withdrawals. If you're sure you won't need to access the money for the specified period, CDs are a good way to grow your money passively. Most banks offer variations on these four main types of accounts. Interest rates and minimum balances will differ from bank to bank and account to account. Once you've decided on which type of account and which bank to use, you can then ask about what options they have available under your preferred account type. Understanding interest rates. We've discussed interest on bank accounts a lot, but you may find yourself wondering, what is interest? Why would you earn it on a savings account? The interest you earn on your bank account, usually savings accounts, MMAs, or CDs, is essentially the money your bank gives you for storing your money in that bank. This is paid as a percentage of your balance. So if your bank account offers a 1% interest rate, you'll earn more if you have $100,000 in your savings account than if you have $10,000. The interest is paid to you because a bank essentially borrows the money you store with them to finance loans given to other customers. When you take out a loan, you must repay it with interest. A portion of that interest is paid out to you in your bank account. This is also why a checking account does not usually pay out interest, because you will frequently be accessing the money in that account. Because you will be frequently accessing the money in that account, your bank cannot lend it out to other customers, and so cannot pay you interest on the money in that account. Interest earned on savings accounts is compounded. Consider a situation in which you have a 10% annual interest rate on an initial savings account of $1,000. Keep in mind that real interest rates are significantly lower than 10%. This is purely offered as an example. In the first year, you will earn 10% of $1,000, which is to say, $100. This interest, unless withdrawn, will be retained in your bank account, and you will have a new account balance of $1,100. You will earn another 10% as interest on your bank account in year 2. However, you will now make 10% on $1,100, which is $110. So, you're earning more money as interest as you did in year 1. In this way, you can earn quite a bit over a long period of time on a savings account, which can help you grow an emergency fund. This is why it's generally recommended you ask around at different banks to see which offers the best interest rates. Keep in mind that just because a bank offers high interest rates doesn't mean it's the right option for you. Some banks offer high interest rates due to other failures in their institution, such as a lack of federal insurance, bad customer service, and risk of failure. Make sure you research a bank thoroughly before choosing it to look after your money. Banks can be complex institutions to navigate, especially if you don't have any prior experience with them. However, as long as you do your due diligence, you'll soon realize that they're not as incomprehensible as they seem. If you have any further questions or find that you have difficulties navigating the banking system, don't hesitate to reach out to a staff member at your bank for help. They'll be able to understand your financial needs in depth and guide you regarding which account is best for you. Additionally, always remember that you are not limited to one bank. You can also open accounts in different banks. This is often seen as a strategy that allows individuals to hedge their bets and ensures you don't put all your eggs in the same basket. Furthermore, while one bank may offer the perfect checking account, another may be better for your savings needs. By keeping all your options open, you can make the best of both worlds. Credit cards. You have heard about credit cards and debit cards, but some misconceptions are often associated with them. This chapter will explain the difference between a credit card and a debit card. We will also explain the time value of money and why it is important to understand it. We also discuss credit card myths and everything you may want to know about credit cards, including their dangers. What is the difference between a credit card and a debit card? Credit cards and debit cards share several similarities, like 16-digit card numbers, magnetic strips, expiration dates, and EMV chips. Both are convenient and easy to use, but they come with important differences that can impact your financial situation. A credit card is offered by a specific financial institution, like a bank, and it allows the holder to borrow money from the institution. When you apply for a credit card, you agree to repay the money borrowed interest. In other words, a credit card works like a loan facility where you borrow some money to purchase different products and services. On the other hand, a debit card is issued by your bank, and it is linked to your checking account. When you use this card to purchase products or services, you are using the money you already have in your account. There is no interest in using your debit card, since you will be buying different things with your money. The only difference is that credit card is plastic money. When no money is available in your account, you cannot use your debit card to buy goods. Credit cards belong to different categories that include the following. Standard cards. Provide a line of credit to the users for cash advances, balance transfers, or making purchases. They have no annual fee. Premium cards. Offer various perks, like airport lounge access, concierge services, and special event access, and they come with higher annual fees. Reward cards. Provide travel points, cash back, and other benefits depending on usage of your card. Secured credit cards. You pay an initial deposit that acts as collateral. Balance transfer cards. Have low fees when transferring balances to another card. Benefits of using a credit card. You can get many benefits from using credit cards, such as discounts, cash, and travel points. You can use your credit card to get discounts on your flight bookings. The following are some of the advantages of using a credit card. Build credit history. You can use your credit card to build your credit history as all transactions appear on your credit statement. Timely payments contribute to a positive credit score, while late payments negatively impact it. Warranty and purchase protections. If you buy a product whose manufacturer's warranty has expired, your credit card company can provide coverage. Fraud protection. Credit card companies offer fraud protection, and the maximum liability of purchases conducted after the loss or theft of the credit card has been reported is $50. Credit card users can dispute goods that are damaged during shipping. Disadvantages of using credit cards. The main disadvantage of using a credit card is that it can so easily lead to a cycle of debt. When you use your credit card, you spend the bank's money, not yours. This money will be repaid with a good dollop of interest, and you'll have to make a minimum payment every month. If you have multiple balances on different cards, it can strain your brain to remember each one, not only your budget, and you may fail to keep pace with your monthly budget. Late payments can affect your credit history. Furthermore, credit card usage comes with interest and fees, since this is a form of short-term loan. The interests and fees vary depending on the financial institution involved. What is a debit card? A debit card can be used for making payments by deducting money from your checking account. You must have a savings or checking account to get a debit card. The following are the common types of debit cards. Standard debit card, linked to your bank account. Electronic benefits transfer cards. State or federal agencies issue these to users who qualify to use their benefits for making a purchase. Prepaid debit card, issued to people without bank accounts. Many people prefer to use debit cards to eliminate the danger of building up huge credit. With this card, you will be using your money, so there is no way you can rack credit. Debit cards issued by Visa or MasterCard offer fraud protection, giving you peace of mind. Debit cards don't have annual fees, and you will not be charged for withdrawing your money from the ATM. You cannot earn rewards for using your credit card. Your debit card does not help build a good credit score. Debit cards come with fees, such as using foreign ATMs. You don't earn rewards for using your debit card. Credit card myths. There are several myths associated with credit cards, and some of them make people skeptical about using these cards. While some myths hold some kind of truth, others are false. The following are some things you should know about credit cards before getting one. You must keep a balance on your credit card. Many people believe that you must have a balance on your credit card if you want to build your credit. Instead, carrying a balance on your credit card can attract interest. However, you should pay off your credit balance in full every month if you can. Make all payments before the statement date to maintain a clean record and avoid interest costs. It's best to close the card after paying it off. Closing your credit card after paying it off can damage your credit. This can lead to the shortening of your credit history, impacting your credit score. You can keep it active by making small subscriptions. High credit is bad. Another myth is that a high credit limit is bad, but the opposite is true. If you have self-control and you can manage all your monthly payments, there is nothing wrong with using a credit card. You should try to keep your usage lower and make sure you spend money you can afford to repay each month. Credit score increases by spending more. Some people have a misconception of believing that spending more can lead to a rise in the credit score. However, the truth is that credit usage and regular payments determine your credit score. Your credit score is not related to how much you spend, but the way you use your credit. You can lower your credit score by checking it. Another myth is that checking your credit score can lower it. The truth is that it is a good thing to monitor your credit. Hard inquiries will go to your credit history, and soft inquiries will not affect it. You can use your bank or credit card app to check your credit score in real time, and this is regarded as a soft inquiry. It does not damage your credit. Checking your credit reports shows that you are responsible, but you must not overdo it. You must pay the minimum due amount. Some people believe that you must only pay the minimum due amount on your credit card each month, but if possible, try to pay as much as you can. Although it is okay to make the minimum payments required by the credit card issuer. However, interest charges will continue to build, so paying more is better. Maintain your credit card usage at 30%. Some people believe that your credit card usage should be maintained at 30% to create good credit. The truth is that you should not exceed 30% of the limit on your credit. Keeping it at zero is the best method that can help you avoid paying high credit card interest rates. Your payment history is the most important factor that determines your credit history. You must avoid late payments if you want to build a good credit score. One credit card is enough. Although some people believe that one credit card is enough, you may need other credit cards since they bring other perks and benefits. As long as you exercise financial discipline, there is nothing wrong with having more than 2 credit cards. Other credit cards offer the best rates for international travel bookings. When you apply for a credit card, you should know its benefits to make an informed decision. Feel free to check with the credit company to get the best card that suits your needs. What is credit score and how to keep it stable? A good credit score is vital to qualify for the best mortgage, credit card, and competitive loan rates. A credit score is measured from 300 to 850, and it is used to determine your eligibility to get a loan. Your credit score tells the lender about your ability to repay your credit and potential credit risk. There are mainly 2 methods of measuring credit scores: FICO and Vantage Score. In the US, FICO is commonly used to measure your score. Credit scores are divided into the following ranges by FICO: 300 to 579, very poor; 580 to 669, fair; 670 to 739, good; 740 to 799, very good; 800 to 850, excellent. On the other hand, Vantage scores are measured according to these following ranges: 300 to 499, very poor; 500 to 600, poor; 601 to 660, fair; 661 to 780, good; 781 to 850, excellent. If you have a poor credit score, you may not qualify to get credit, since you will pose more risk to the lenders. You may be charged high interest if you qualify to get a loan with a low credit score. Building credit score. When you have bad credit, there are different measures you can take to improve it. The following are some of the aspects you should prioritize. Make timely payments. Your payment history is the most critical factor determining your credit score. Make sure you pay all your bills and credits on time to improve your rating. You can set auto pay for smaller credits. Pay in full. To reduce your credit utilization rate, you should meet your minimum payment requirements. Avoid opening several credit accounts. Whenever you apply for credit, an inquiry appears on your report whether the loan is approved or denied. Your credit score will be affected by about 5 points, which can impact your score, although it is temporary. Maintaining several lines of credit can pose some challenges in the long run. If you have a good credit score, you can qualify for a mortgage, car loan, or other forms of credit. It also helps you get the best APRs from lenders. A good credit score also helps you get the best credit card with many benefits, like rewards and discounts. However, credit card issuers also consider other elements, like your monthly income and other credits you have. Understanding time value for money. The time value of money, TVM, is an essential tool that helps you understand the worthiness of money compared to the value of time in any kind of investment. The basic underlying principle of the TVM concept is that money has more value in its present form than in the future, since it can be affected by elements like inflation. For instance, $1,000 can buy you more things today than you would get with the same amount 10 years from now. The TVM concept helps you make an informed decision when you invest your money, considering that its value changes. You are likely to encounter some risks when you invest in a business. Therefore, you will choose the best investment option when you understand the inflation, interest, risk, and return elements. If you find a good investment option that gives you healthy interest, it can be a good idea to consider it since it will give you more money in return. The danger of credit cards. A credit card offers many benefits, but it can be potentially dangerous. If you are a new credit card user, you can easily fall into traps like believing the promises offered. If you intend to get a credit card, you should know the dangers associated with these cards. The following are some of the dangers you should know about credit cards so you can use them responsibly. Avoid the temptation to overspend. Many people often spend more when they use credit cards than when they pay with cash. When you buy with a credit card, you don't feel the pain as you do with cash. The bad part about a credit card is that you will be using the money you don't have. You can buy using cash to avoid this challenge. Additionally, make an effort to pay your balance in full. Risk of getting into a debt trap. Whenever you borrow money, you will be creating debt. If you continue to borrow without paying, you will create a debt trap, leading to a myriad of other challenges you can encounter. Debt leads to health-related problems, such as depression, stress, and other conditions that can seriously impact your well-being. It can be difficult to realize your financial goals when you are overwhelmed by debt. When you spend more money on debt repayment, you will be left with little cash for other priorities, such as saving for retirement plans. You can also delay other goals like pursuing your studies when you are debt-ridden. When you realize that you are failing to pay your credit card balance in full every month, you should stop using your credit card. Instead, use cash and try to live within your budget to avoid ruining your financial situation. Risk of damaging your credit score. If you miss your monthly credit card payments, your credit score will slide, and you may not be able to get a loan in the future. You also risk ruining your credit score if you fail to exercise discipline with your credit card. The best way to avoid this situation is to maintain your balance below 30% of the credit limit, pay your balance on time, and minimize the number of credit cards you have at any given time. Minimum payments can give you a false impression. Your credit card requires you to make minimum monthly payments to avoid late fees and maintain your account in good books. However, there is a danger that this can give you a false sense of security, since your balance will remain even if you maintain minimum payments. This will also attract more interest, so you will not be doing any good by paying minimum interest. It is a good idea to pay your balance in full if you can. If you cannot afford to pay in full, try to pay more than the minimum balance required by that lender. This will help you reduce the interest on your balance. Credit card terms can be confusing. Credit card terms and conditions can be confusing, impacting your repayment plan. There are serious consequences for misunderstanding the terms and conditions of your credit card. A single credit card can come with different interest rates, and you may not know the right ones to use. This can lead to increased interest rates and fees. You should read between the lines to understand the types of balances and interest rates each credit card carries. It is vital to consult your credit card issuer's customer service to get all the details you may want about your credit card. It is difficult to track spending on several cards. It can be difficult to track your spending when you have several cards, affecting your repayment plan. If you use your credit cards together with cash and debit cards, it will be difficult to monitor your spending. As a result, you may overspend because you will be out of touch with your finances. You should use different methods to track the expenses on your credit cards. For instance, you can track your spending manually or use special software. Check all credit card statements and report any suspicious activity to your credit card issuer. Credit card fraud. Credit card fraud is common, and it can lead to financial loss. There is a risk of losing your credit card or your personal information can be stolen. If you lose your card, you should quickly make a report to your credit card company. It is essential to monitor your credit card closely, and you should not share it with anyone. High interest rate. If you fail to pay your credit balance in full every month, there is a danger that interests will add up quickly. The interest charged by the issuer depends on the type of credit card you have. Choosing the best credit card that suits your needs is crucial to avoid issues like high interest. You also need to strive to pay your monthly balance in full to avoid high interests and fees. If you cannot pay the full amount, make sure you pay more than the minimum amount required. You also need to exercise financial discipline when you use your credit card. While credit cards and debit cards share many similarities, they are very different. A credit card provides a line of credit from the issuer, and it comes with interest, whereas a debit card is linked to your savings or checking account. If you want to maintain your finances in good order, a debit card is your perfect fit. If you are concerned about cashing rewards and building your credit score, you can consider a credit card. No matter which option you choose, you should know the benefits and downsides of each.